Good morning, students. This is Abhinav Khandelwal from SR International School, Bareilly, and welcome back to the accounts class. What we have studied in the previous class, we have started the chapter number 1, and the name of the chapter was Meaning and Objective of Accounts. And we have done there the three topics, that is bookkeeping, accounting, and accountancy. And I hope you don't have any problem with this. So better now what we are going to start, we are going to start another very important topic from the viewpoint of accounts, and that topic is qualitative characteristics of accounting information. What are the qualitative characteristics of accounting information? So beta, this is a very important point because it consists of numerical based theory as well. So what you will learn in this theory, it will help you to solve your numericals as well. So when we start, let's start with the first point now, beta. There are 5 qualitative characteristics of accounting information, as you can see it on the board. The first one is beta reliability, relevance, understandability, comparability, faithful presentation. Now the first one is reliability. So let's start with reliability only, beta. Now what do you mean by the term reliability? Reliable means trustworthy. Is it clear or not? Trustworthy means a person whom we can trust. But accounts is not a person, as we all know. So accounts should be presented in such a manner that everybody can have a trust on accounts. And how they can have a trust on accounts? I hope you remember we have studied in accounting principles, and that's why I started this chapter so late, because once you will finish all the chapter you came to know about this chapter. So beta, in accounting principles we follow one principle which proves that account should be recorded on some evidences, and if it is recorded on some evidences or documents, then it will be a trustworthy. So beta, what are the evidences and what was that principle? The principle was historical cost concept. I hope you remember about that principle. And in that principle we studied that what we are recording, we will record it in the cost. And why cost? Because cost is verifiable, which means that it can be verified from any sources. That it, yes, from what sources we can verify it, beta? We can verify it from various documents, just like cash memo, invoice, pay in slip, etc. Similarly, what they are saying in reliability they are saying that account should be reliable, and it's reliable only when you have a source document along with you. You are recording the transaction on the basis of that source documents. For example, if I say that I have purchased goods on credit, so I should have the invoice bill with me, so that if anybody is questioning me, I can show them that bill and I invoice, and I can show them that I have purchased goods worth rupees that much. Is it clear, beta? So do you understand the meaning of the term reliability? Reliability means trustworthy. Now coming towards the second topic, and the second topic is relevance. Relevance means whatever it is required. Look, in accounts, if we say that we can record everything and which is not required, then the accounts will get bored. Accounts will get boring, and the users of accounting will not take any interest. So accounting information should be relevant. Now what is relevant? It is a big question for all of you, because some people relevancy is different as compared to some other. For example, if we take the example of bank may require some other information as compared to the investors of the company. So the accountant here needs to be very careful. He have to find out the main points which are relevant to all, and record in books of accounts only those transactions which are relevant to all, which means that any useless transactions which are not required at all should not be shown in the books of account. And again, what is useful and what is relevant, it is a big question mark. So the accountant needs to be very careful here, and he have to judge that whether this thing is useful for anyone or not, and then only he will record everything in the books of accounts. So is the relevance clear, beta? Understandability is the third point. So what do you mean by the term understandability? Understandability means that account should be presented in such a manner that it should be clearly understandable to everyone. Clearly understandable to everyone means, for example, if any person who don't have any knowledge of accounts, he also can understand the account, it should be presented in such a summarized and clear manner. For example, if we talk about profit and loss account, we have two sides, debit and credit, and we says that debit is what beta? All expenses, and credit is all income. So all the expenses are recorded on the debit side and all the incomes are recorded on the credit side, which is easily comparable and easily understandable as well. So even a layman can understand. Understandability will make it quite clear and will be more effective if you will give explanatory notes regarding every item which is necessary to give explanatory notes. You will give footnotes, as we told, as we have studied in accounting principles, that is convention of full disclosure. And I told you over there that if something is not coming in the books of account and it is very important, you have to give a footnote. So how can it be understandable to everyone? By giving explanatory notes and by making accounts very simple. Is it clear, beta? Now beta, coming towards the fourth point, comparability. Look, accounts will be of no use if we cannot compare it. That's why the company law makes it mandatory now, from now means from 2013 onwards, that whenever you will prepare, any company will prepare accounts, it will be on a consolidated basis. What this consolidated basis means? It will be of 2 years, that is previous year and current year, so that any person who is studying accounts, whether it will be an investor, creditor, owner, management, whoever is there, so he will be able to compare the items of previous year with that of what beta current year. Similarly, they also say that other companies in a same kind of business should also follow the same practice. And how it will be done, beta? If they will follow the accounting principle, so that the accounts of one company and another company are also comparable. So beta, what we say that we should follow the same rules and regulation every time. Just like consistency, we have studied about consistency, but it does not mean that we cannot change our methods. For example, if we say that we are changing the value or methods of depreciation, so beta, we can change, but we have to prove that accounts is giving a better result by changing, and such change should be required to be presented by way of explanatory note or footnote at the end of the what beta accounting statements. Is it clear, beta? So what do you mean by the term comparability? In order to make it compare. And the last one is beta faithful presentation. Now what is faithful presentation? It means that account should be trustworthy, and whatever you are reporting to the owners, management, creditor, it should be faithful. Means any person can rely on that information. And how does they will rely? We have studied in the first point as well, by the help of what beta vouchers or source document. It become the trustworthy document as well. So I hope students it's clear to you. So please go through it. If you are facing any problem, then please ask. Otherwise, we will start the next topic from tomorrow. Thank you, students.